In this week's video, we'll use 19 charts to take a simplified look at the bull versus bear debate. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a weekly chart of the S&P 500 index. We'll use it to remind ourselves of some very simple concepts, and then we'll apply them across numerous 2016 markets. S&P 500 weekly. Here, the market is able to make a significant higher high, which enables a new pattern to develop, a bullish pattern or a weekly uptrend that is formed by a series of higher lows and higher highs. When the S&P 500 makes this lower low here in 2011, it tells us something about the battle between bullish and bearish conviction. Conversely, when it prints a higher high here, we learn something about bullish conviction relative to bearish conviction. And what we learn is quite a bit different here than it is here. And an incredibly important concept about bullish and bearish trends is the fact that it is mathematically and physically impossible for the stock market to move from this point here to this point here and all points in between without first printing a significant and new higher high. This absolutely positively has to happen. We can't get to this point, this point, this point, or this point until we're able to clear this level here. This is what a weekly bearish trend looks like. This is the year 2000 S&P 500, 2001, 2002, where my cursor is. This is a meaningful lower low here, and then it's followed by a series of lower highs and lower lows forming a weekly downtrend. Now let's look at numerous markets in 2016 and also apply the concepts we've learned in recent weeks about asset class behavior and ask ourselves, what can we learn from the big picture? So again, let's assume that we're taking a multiple choice technical analysis exam and we are presented with this chart and we are asked, is this a weekly uptrend or a weekly downtrend? The answer is relatively simple because this particular weekly chart or example is printing a series of lower highs and lower lows. Despite the recent sharp rally in the S&P 500, the chart we're looking at is the present-day chart of the S&P 500 on a weekly time frame as of Friday, April 15th. Still, I know I sound like a broken record, this move here from a trend perspective really doesn't look much different than this move here. There are some exceptions. This move has gone on for a longer period of time, and it's also covered a greater percentage move on this chart, telling us to keep an open mind about the possibility of this chart printing a meaningful higher high above these levels, and more importantly, above the levels from the spring of 2015. But the important takeaway from the model is we don't predict that that's going to happen. What we have in hand right now, this high here is a lower high relative to this high, and this high here is a lower high relative to this high. This low here is lower than this low, and this low here is lower than this low. All subject to change, but it hasn't changed yet. How about this chart here? It looks a lot better because it is firmly in an established weekly uptrend, making a series of higher highs and higher lows. Is this an economically sensitive asset in 2016 that's provided leadership recently? No, in fact, we've been looking at the weekly chart of IEF, or the Intermediate Term Treasury ETF, as of Friday, April 15th, 2016. The last thing this weekly chart did was print a new weekly closing high. It's a little more difficult on this weekly chart, but upon closer inspection, we find that this low here in early 2016 was lower than this low here, and this strong rally here has yet to print a new weekly closing high. It's extremely close, but in this business, close doesn't count. We need to see a higher high. This is the weekly chart of the Dow as of Friday, April 15th. DIA, or the Dow ETF, is starting to move up the ladder a little bit in terms of our ETF screens, but it still can't make the cut. But mathematically, this chart is absolutely positively improved. It just needs to improve a little bit more. We'd be more inclined to take a look at it if we can move into this area here, and more importantly, if we can break to a new high. All of that is in the to be determined category. Moving on to our next chart. This one is easy. We can clearly see a downtrend where the current rally, where bullish conviction has yet to be strong enough to really even get in the neighborhood of the previous highs from late 2015. This chart is a weekly risk-on, risk-off ratio. This is emerging markets EEM relative to defensive long-term treasuries TLT. This is an impressive rally, but it doesn't look that much different yet relative to this counter trend rally here that was fully retraced. This chart has some work to do. We'd be more impressed if it can move into this area here. This weekly chart looks pretty good and is clearly still in a bullish uptrend. This retracement here in March of 2016 really isn't in striking distance of the prior low from the downturn that occurred late in 2015 here in November. What can we learn from this chart? That there are still concerns about the economy and credit risk. This chart is a I'm concerned relative to I'm confident weekly risk off versus risk on ratio. We're looking at IEF, intermediate term treasuries, or defensive bonds relative to higher yielding or more aggressive or more confident JNK as of Friday, April 15th. On our test, this is about as easy as it gets. On this particular question, I am checking downtrend and moving on to the next question. This is the weekly risk-on versus risk-off ratio, the S&P 500 or SPY in the ETF world, relative to long-term treasuries or TLT. A few takeaways. In a downtrend, ratio has made a lower high recently. This high is lower relative to this high. This high here is lower relative to this high, and two lower lows in the short run. So over the past few weeks, as the stock market's been rising, this risk-on, risk-off ratio has been falling. To make a convincing case from a bullish perspective, we really need to take out these previous highs from the last rally that occurred off of the September-October lows in 2015. That absolutely positively may happen, but the facts that we have in hand right now say this important ratio is making a series of lower highs and lower lows on a weekly chart. It's subject to change, but it hasn't changed yet. This weekly chart is the exact same ratio. We've just inverted it, and this is telling us that bonds are still in an established and ongoing weekly uptrend relative to stocks, also subject to change. But for a big change to take place on this chart, this low here from 2015 needs to be taken out. After the stock market has rallied for weeks in favor of SPY, you can see we're really not even in striking distance of making an important lower low on this chart. From a probability perspective, looking out weeks, months, and years, as it sits now, this chart still favors defensive bonds relative to growth-oriented stocks. On this particular chart, it would be pretty easy to choose downtrend because the weekly chart of crude oil as of Thursday, April 14th, was still making a series of lower lows and lower highs on the weekly chart. The impressive rally off of this low becomes quite a bit more impressive if it can exceed the highs made in the second half of calendar year 2015, and we're not particularly close just yet heading into this week's OPEC meeting. Moving on to the next example, a chart that's clearly making a series of weekly lower highs and weekly lower lows. We learned something from a bullish perspective. If bullish conviction can push IWM above the previous highs that were made in November of calendar year 2015, this chart still has some work to do. Notice on this chart here, it's not always clean. This is a lower weekly low relative to these lows here, but it never really gets in striking distance of this low here, allowing the longer term uptrend in this case to remain intact. Same thing here. This chart could still fall quite a bit as it did here, and this area here still wouldn't be close to the lows that were made in November of 2015, telling us that we're still dealing with a bullish and upward sloping weekly trend. This bullish looking chart here actually sides with defensive oriented TLT relative to growth oriented, or I'm confident about the future IWM. On this weekly chart, we have a nice move here and we have a nice move here. However, XLE, or the energy ETF, still fits the textbook definition of a weekly and established downtrend. The bullish case for global stock markets and for energy stocks would improve if this ETF could print something above $69 a share. On Friday, April 15th, it was trading around $63 to $64 a share. What can we learn from this weekly example? That despite the multiple week rally in XLF, it's nowhere near making an important higher high above the November 2015 highs. That may happen, but it hasn't happened yet. This chart, which is still in an established downtrend, will tell us a lot about the case for reflation versus the fear of a recession and or deflation if we're thinking in extremes. What is this chart? We're looking at materials XLB relative to defensive treasuries. While numerous stock indices are in striking distance of these highs, what does it tell us about economic confidence when this ratio is really not even close to taking out this level here, despite weeks of rallying, and we also have somewhat of a tepid look here over the past few weeks. Another easy one from a weekly perspective, we clearly have a downtrend here. What can we learn? That the NASDAQ or technology stocks remain in a weekly downtrend until price proves otherwise. Same is true of the weekly chart of the broad NYSE Composite Stock Index. Last important thing it did was print a new weekly lower low. It has yet to print a new weekly higher high above the November 2015 high. That may happen, but it hasn't happened yet. It can't be emphasized enough, the topic that we've covered several times in all the videos from 2016. When we show any of these charts or any comparisons to any periods, we are not forecasting anything, including a bear market. The only thing we're doing with these charts is saying that what we know is that we're in an existing downtrend. Not much has changed relative to commentary in the past few weeks. This chart and many others say that we could still move higher and remain in a downtrend. This is the October 2014 low in the S&P 500 weekly. February 2016, we make a lower low. If we move up to the next high and use the same angle, it says that we could move all the way above 2100 and we would still be bounded on this chart, telling us to keep an open mind about all outcomes over the next few weeks. We know this with 100% certainty. If some wild bullish advance has started and it's going to last another 3 months or 3 years, the S&P 500 weekly absolutely, positively will clear this line here. It will clear 2100 on a closing basis, and eventually it will move and close above 2120, and eventually it will close above this line here. From a percentage perspective, trying to be patient between point A and point B is relatively small when we consider the move could be from this point A to this point B if the existing downtrend remains in place. And if it does, we would be making a lower low below this low. No predictions at all. We're allocated properly based on the evidence in hand. The ETF scoring system is backing what we're doing, as well as these charts here, and all of it simply speaks to probabilities. Could the lower probability outcome occur where the stock market moves into this area here? Absolutely, positively, yes. And that's one of the reasons why we've started migrating a little bit up the risk ladder in terms of adding another hybrid asset to our portfolio. That hybrid asset is scoring very favorably, and it was very, very easy to add that hybrid asset as well as the one that we added a few weeks ago. But if those type of assets are your leaders, what does that say about economic confidence? As noted on Twitter this week, higher prices are never impossible, so the probability of the S&P 500 breaking out and moving to 2350 is absolutely within the realm of reason. It is a lower probability outcome relative to some type of reversal in this area. Also, if the downtrends remain in place, it's not out of question to say that the S&P eventually could get as low as 1600. Therefore, our portfolios and our game plan need to have a plan for what happens if we surprise on the upside and go to 2350, and the hybrid asset that we added this week, think of that as an insurance policy or an insurance premium against the lower probability case. If we move from point A to point B, we need to have a game plan for that, and we need to start taking steps in that direction. Conversely, if the downtrend remains in place, we also need to have a game plan for that. Flexible and open-minded will allow us to deal with both outcomes as long as we pay attention to the model, the facts, the rules, and most importantly, the observable evidence. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.